floor is yours.
Yeah. Okay. So I'm Jose Maria Macedo. I'm a founding partner at AmaZix Capital, where we used to be. So I started off at AmaZix, where I helped co-found the advisory department. We ended up AmaZix worked with most of the big token sales. We worked with about 150 projects and helped them raise 1.3 billion. And we did basically token economics work, white paper writing, technical paper writing, financial modeling, that kind of thing. And then from there, we had a lot of demand for sort of corporate finance services, M&A, STO advisory, fundraising, that kind of thing. So we spun off a separate company called AmaZix Capital, which is a regulated entity out of London, with my partners, Joachim Godet, who's a very experienced investment banker, 20-year career at Goldman Sachs and Lazard's and that kind of thing, but also very into crypto. And another partner from AmaZix called Luke, who's a programmer, and myself, more on the token economic side. And then we have 4 other partners who are bankers and lawyers, so a pretty multidisciplinary team, which I think is kind of what you need to tackle the project that we're working on in this space. Before that, I was an entrepreneur. I had a successful exit, and before that, I was a professional poker player. I was one of the best in the world at a specific style of poker called Six Max No Limit Hold'em. Was sponsored and stuff. It was a lot of fun. That's where I learned about game theory, and which really helped me understand crypto afterwards. And yeah, Kevin, I don't know if he's here yet, but he is. I mean, I don't know if I should intro him. Probably just wait for him to join. Yeah.
I asked him but I don't know. Maybe he's trying to reconnect. I think so.
Okay.
So Kevin. Would you?
I'll intro Kevin if you want.
Okay, sure. But with the Kevin voice. Different voice.
No, that's difficult. American accent, quite deep. You'll like it actually when he comes on. He's got a good voice. But
I know they're based in New York, so I'm not gonna be the only one. Yeah.
Yeah, they're based in New York. So he is his background is financial industry. I think he was a macro strategist at Bloomberg. And so were all the other partners at Delphi. So they were all financial industry guys. They were either equity researchers or macro strategists. So in the research space, and they all sort of quit their jobs together to found Delphi, which in my mind is probably the best research company in the space. They have some pretty high profile clients, a lot of the best funds in the space, and they just do they just do research on the macro side and also on the on specific tokens and stuff like that. And yeah, Kevin is very strong on the macro side, and the idea was that he would introduce this by talking about kind of the macro effects of coronavirus through the lens of the dollar, and then we talk about the effects on crypto. Let me just see.
And I think we have Kevin. Can you?
Kevin? Ah! There he is.
We can see you. Oh no, he disappeared. No, he's still here.
He's there. You just need to unmute yourself. There he is. We can't hear you.
You can mime it. Sorry, I'm really trying. Maybe in your browser access as well. Maybe.
Yeah.
And so is AmaZix working with Delphi Digital, or is it like a relationship, or are you guys separated entities?
Yeah, we're separate entities, but we've worked together on quite a few projects. We've done a lot of token economics work ourselves, and we kind of read their research pretty thoroughly, and that's how we got in touch. And then we've worked together on a few projects, some token economics projects, some research projects. And yeah, we have a pretty kind of tight relationship.
And no, very nice. Oh yeah, it's still muted.
You're still muted. We can't unmute him from the browser.
No, it's that's it's not like as granular as Zoom. So it's all like the power to.
You guys only have one working microphone between the two of you. Obviously, you didn't make enough money.
Yeah, exactly. It's tough out there.
So maybe if you want to start, Jose, by telling us maybe like, because you guys at AmaZix Capital wrote a pretty extensive report, right, on like the institutional case for post-COVID and digital currency in the post-COVID world. So maybe like, you know, just start with your oh, we're so close.
I know. It's annoying because he was first. his bit was first.
I'm messing up all your scheduling.
Yeah. Is okay.
You're in Jitsi, but still can't hear.
Oh, is he unmuted? No. I think you just unmuted yourself for a second. Do it again, Kev. No. Unmute. Speak now. No. Fuck's sake. How does the webcam work, but not the microphone though? It's pretty bizarre.
Can you nod yes or no to my questions, please, Kevin? Are you using Chrome? You are. Okay. Do you see the two buttons for the microphone and the camera at the bottom of the screen? Have you clicked on the microphone and selected a microphone? Okay. Good. Are you on OS X or are you on Windows?
What if you try without the headphones and just use the computer mic?
Is he using Mac OS or is he on Windows or Linux?
Windows. I don't know, actually.
Okay, so if you're in Windows, you might need to go into the actual system level preferences to allow the microphone and screen sharing and those different things. That seems to be one of the issues. Is that it's not a browser issue, it's a system level permissions thing for Chrome.
It's pretty annoying. Do you want to try on your phone or something?
One other question. Are you logged into the portal.interspace.chat, Earl, or are you logged in? Yes? Okay. Do you have any other programs running that might have taken your audio? Were you using Skype or Zoom or anything else?
No.
Oh, yeah, we can hear you.
Yeah.
Oh man. Leave it to a virtual.
Sorry. You're here.
Challenge. Jeez,
It's the fun of the virtual events.
All right.
Congratulations.
And welcome.
Unbelievable. All right, let's get this show on the road. I appreciate the intros, eh?
I didn't know much.
Yeah, come on, you made it on purpose.
just
I'm sure you did it on purpose, so like you get introduced, you know.
Yeah, exactly. All right. So let me see. Now here comes the fun part. This should be hopefully easy.
Sharing screen. Yeah, it should be easy. Boom.
Actually, one more thing, Kevin. If you now click on the video icon, the little arrow, you can select in there that you can be visible, picture in picture with your slides as well.
Yeah, okay.
There we go. Cool.
How's that?
Yeah.
Good to go? Awesome. All right. Only 15 minutes late. So, appreciate, like I said, appreciate the opportunity to be here. Thank you, Jose, for holding the fort down a bit. Him and I have gone back and forth a good amount about this topic, so pretty excited to talk to you guys about it, share some of my thoughts, share some of his thoughts. We thought it'd be easiest to just kind of combine our key themes and kind of slides into a quick deck here, which I'm sharing now. And I'll go through, and then Zay, when we get to your parts, I can just toggle through for you. But a big part of what we wanted to frame, especially in this kind of post-COVID world that everyone's trying to think about, and a lot of the work that we do at Delphi, I know Jose gave us kind of the intro, but we work a lot with kind of the more investor side of both the crypto space and then some traditional institutions that are trying to make sense of this space, trying to figure out how to allocate capital to it. And so a lot of our work comes from more kind of investor mindset and where you can find, opportunities, what the risks are, things of that nature. And so that's kind of the basis for this presentation. And so one of the big things, you kind of want to set the stage for is just what we're going through right now. And I think this certainly does. I mean, it's not trying to be fear-mongering or trying to instill the fear of God in people, but I really do think that this has the potential to be kind of one of the largest economic events that many of us have seen, in our lifetime, or at least on par with some of the worst events that we've seen. And the reason for that is more so the kind of consequences of some of these political responses to COVID-19 and what the aftermath of the knock-on effects of that can be. That's not to say that the policy responses have been incorrect. Certainly are all in favor of social distancing and obviously trying to flatten the curve. But I do think it is important to kind of put that in context and understand what's kind of going on at a base level in the economy. And then again, we'll kind of feed into what that means for the US dollar, which is a very kind of critical theme right now in the macro space, and how that eventually plays into the kind of longer term outlook for crypto. Some of my slides, I've focused a good amount of my time on Bitcoin. I know obviously this is an ETH conference, but I think a lot of what we're talking about here is going to be, and we'll get into the Web3 argument, but a lot of what we're talking about here is certainly be applicable across the crypto sector at large. And so here, I mean, this chart is basically just showing how this economic event is starting to really show up in the data, right? So if we set the stage, why is it important right now? One of the big things that the world, and I'll use the U.S. as my primary example here, because that's where I'm based. I'm in New York City, but this certainly applies, on a global scale. One of the big things right now is just this kind of exogenous shock, this massive exogenous shock to cash flow for a lot of businesses, right? And the reason that becomes a problem and an issue, and you're starting to really see this play out, both on the kind of monetary and fiscal side of things, is that when you have that big of a shock to cash flow and revenue and sales, we live in very kind of debt-based or debt-driven economies. And so what this chart basically shows is here in the US, the amount of non-financial debt versus GDP, and you can see how high these levels have gotten. And that's really where I think the crux of the potential fallout from this can really stem from. You get these kind of knock-on effects where, depending on how long this lasts, depending on how long small businesses are either cutting employees or simply forced to close up shop, how long the duration of this kind of crisis goes on for, potentially could have some really significant effects, for years to come, because we could start to see this kind of credit cycle peak, debt deflation, things of that nature that we're going to get into. But credit is really kind of the center focal point right now, at least for us, as we're kind of trying to evaluate how things are going to play out in the economic sphere. And it's not just a U.S. problem, right? This chart basically shows how big the size of the global debt burden has gotten. It's surpassed 320% of global GDP, and that debt is becoming less and less productive. That's kind of a key theme as well. So not only are we taking on more debts, which by definition are deflationary because they can hamper innovation, but at the same time, those debts aren't being taken on to invest in productive assets or investment, things of that nature, which is certainly kind of a key theme as you get into this potentially slower growth or even deflationary world. As I mentioned, credit cycle risk, debt deflation, a lot of this is really kind of the focal point right now. And as you can see here, this goes back the mid 60s. But basically, when you look at that kind of non-financial business debt, you look at that year-over-year growth, we're kind of starting to see that peak and potentially roll over, and that's going to have some pretty significant effects for both asset prices in general as well as crypto. And so where we really kind of stand right now, and I'm going to bring this back to the U.S. dollar because it is a very key theme, is we view this kind of a major theme for us is we have to go through this kind of deflationary or deflate period before we can actually reinflate or see the inflation that a lot of people are expecting from a lot of the monetary and fiscal stimulus. And one of the reasons for that is the U.S. dollar kind of sits at the center of the global financial system, and it is one of the largest, I would say, a strong dollar is one of the largest risks to the global financial system right now. And so what you're starting to see is this collapse in oil prices, for example, right? That's a deflationary force that's going to put downward pressure on prices. A strong U.S. dollar is, by nature deflationary, just given all the dollar-denominated debt that is existed in the world and has become extremely popular over the last cycle. Falling asset prices, right, can actually bleed into the real economy. So you've seen, obviously we saw a really, really volatile period in mid-March across just about every asset class. What this basically shows is just the S&P 500 year over year versus retail sales, core retail sales in the U.S. And what you can see is that, during periods of financial stress, oftentimes that can actually, if it's large enough, can bleed over into the real economy. And again, you see kind of aggregate demand fall, consumer spending, things of that nature, moving more towards a deflationary world. It's kind of a big theme, at least in the short to intermediate term that we're watching. And so this really sets up what we've seen on the monetary and fiscal front, and what the extreme policy responses have been. And so what this shows is major central banks, their total assets or their balance sheets. And what you can see is that they've really started to ramp up, especially recently. The Fed has added over $2 trillion to its balance sheet, really in just the last couple of months since we've really been starting to deal with this. And that's a trend we expect to continue, right? And so the question is, what does that end up? How does that end up getting into the financial system? Does that end up making its way into the hands of consumers? Can we see inflationary events take place or inflationary pressures build after all the stimulus comes into the market? And that, again, is what we're going to talk through here and kind of how this potentially could play out. But again, like the level of stimulus is not only unprecedented, but it's also coming at a time in which, again, this is monetary and fiscal policymakers are basically trying to build a bridge for the global economy to get across to greener pastures, right? And they really kind of came to this massive crevice that is, COVID-19 and all the potential adverse effects that we're already seeing to show up in the real economy. Policymakers are basically doing anything that they can, to fight, not only to keep people, in business, to keep money in the hands of consumers, to keep people afloat, but also to fight these kind of deflationary forces that we've set up here. And it's going to be really important because when I bring this back to the dollar, and I've mentioned in the beginning, it's kind of a really core thesis or theme around what we're watching is the U.S. sits in a very unique position in that the U.S. dollar is a global reserve currency, as many of us know. And what that allows the U.S. to do is conduct monetary and fiscal policy unlike other countries. And so what I mean by that is the U.S., people have questioned why, the Fed has printed again, added over $2 trillion to its balance sheet, but the U.S. dollar continues to strengthen. And the fact that there's a large kind of global dollar shortage and supply-demand imbalance in the dollar, because it is the world reserve currency, right, means that the U.S. can take advantage of the world's need for dollars in ways that other countries couldn't. So what you're seeing now is a lot of emerging market and developing countries, a lot of other advanced economies, their central banks are kind of following the U.S., following the Fed, and they're cutting rates. They're starting to come out with large fiscal stimulus packages to try and combat the negative effects of COVID. And that requires, again, hundreds of billions or in some cases trillions of dollars. And there's no real way for them to fund that beside for kind of turning on the printing press and actually having their central banks monetize their debt. And that's going to lead to, and is already starting to lead to, some emerging market currency depreciation, and it's going to really have some long-term sustainable effects on, again, not only just traditional asset classes but crypto too. And so just going through, this dollar debt problem and why it's such an issue. I mean, a lot of countries have issued, and corporates within those countries have issued dollar-denominated debt. This past cycle has been extremely popular because a lot of investors don't want to take that foreign currency risk. And so what that basically means is now a lot of these countries are very, very dollar dependent, right? So when the dollar strengthens, it makes those debt burdens even more burdensome, I guess you could say. But it also tightens financial conditions elsewhere, right? So you almost have the dollar, as Jose likes to say, it's kind of got this wrecking ball phenomenon that's potentially playing out where it strengthens, really kind of brings the global financial system and the markets to a breaking point, and then it's going to swing back and it's going to start to cause some inflationary events potentially as well after we go through this mild deflationary period. And this just shows, again, how popular it's been. This shows the growth in non-bank US dollar-denominated debt versus just kind of total foreign dollar-denominated debt over the last roughly 15 years. And you can just see, there has been an explosion in the amount of debt that's denominated in, hard currency like the dollar. And what we're really seeing, again, this ties back to some of the policy responses we've seen in EM and developing countries. This is just year to date and showing that the trade weighted dollar against emerging market currencies has strengthened quite considerably more than against advanced economies. And again, that becomes a problem because the world is now facing this massive exogenous shock to revenue on both a local level and a federal level. And what you're starting to see is that as the dollar shortage gets worse and the dollar appreciates, it kind of almost has this vicious cycle mechanism built where you see financial conditions really start to tighten in EM. That forces those countries and those central banks to be even more accommodative, and you start to see the potential for broad-based kind of fiat currency debasement really start to play out. And it'll tie into a lot of what we get into with crypto and Bitcoin, kind of the store of value narrative. This is really kind of the setup in which crypto should thrive long term, certainly. And one of the kind of burdens that the U.S. has, having the world's reserve currency, is that the world is essentially structurally short dollars, because when you have these dollar-dependent countries, this, as I mentioned, stronger dollar tightens financial conditions and certainly make this kind of global economic slowdown a whole lot worse. And so what that means is that the U.S. has to basically keep the world flush with dollars, and that's what we're starting to see, is that this global dollar shortage problem has gotten so bad and the imbalance is so large that the U.S. and the Fed are now kind of trying to pump money into the system to keep the system running. But what I think longer term this is starting to show is what the vulnerabilities are of having such a strong kind of dollar standard or world reserve currency at the center of the global financial system. And it's setting up, potential, breakage or opportunity for a complementary system similar to something like DeFi to really start to take off, because the way in which, COVID certainly has pushed the world or accelerated the world towards a global recession. But I think what it's really done is expose a lot of kind of systemic risks or exposures that our system had that we otherwise wouldn't have noticed unless something like this came along. And so when you talk about a world reserve currency, it's not like the rest of the world is naive to this. I mean, you've had a lot of political leaders have warned about today's dollar standard, what the potential ramifications are, and you're starting to see a lot of countries, especially major countries, either vocally or be outspoken about their move away from the dollar or actually doing it. This looks at just the amount of federal debt or treasuries held by foreign investors and institutions compared to the total amount of federal debt for the U.S. And you can start to see it's rolling over a bit. And you're seeing some countries actually bolster up their reserves with things like gold. I think a really interesting example is what Russia's been doing. Again, we know there's tension there between the U.S. and Russia, but essentially Russia sold out of essentially all of their treasuries, and they've replaced that with ramping up their gold exposure because they understand that dollar dependent economies certainly would be extremely vulnerable to a situation like we're seeing play out right now. And so again, as I mentioned, there's this broad-based currency depreciation long term is certainly a huge narrative and certainly a tailwind for not only Bitcoin but ETH, crypto in general. And there's a lot of things that don't necessarily even show up in some of the data that I was showing before in terms of, reported liabilities and federal debt and all of these things. When you look at things like off-balance sheet liabilities, looks at Social Security, the public pension system, which is extremely underfunded. When you add up all of these, the debt burden is actually much, much higher than people expect. And so when you think about what the potential options are going forward, again, this global debt problem, there's really only a handful of things that countries can do, right? You can either grow your way out of it, which, to be honest, the growth outlook right now obviously isn't the best, and part of that's a demographic issue. Part of that's because we just have such large debt burdens to begin with. You could default, which we might actually start seeing in some of these EM or developing countries, depending on how bad this dollar problem gets. And the final one, and the one we think is most likely, is going to be really just kind of inflating away these debts and these debt burdens. And that again sets up that broad-based currency debasement narrative that I certainly think, in a world of abundance, digital scarcity can really thrive and really shine. So with that, I'll toss it over to Zay. I know, try to run through that as quickly as I could to make up some ground. But if there's anything you think I missed or things you want to touch on, more than happy to obviously make possible.
Awesome overview and really great charts for a simple overview of that, man. Good work.
Cheers. Thanks.
Appreciate it.
Yeah, I mean, I'll tie up and I'll give the sort of the wrecking ball, just tie up that wrecking ball metaphor, which as Kevin said, I really like. And it's the idea that sort of as the dollar obviously deflates, so the dollar gets stronger, right? And it gets stronger in terms of other currencies, first of all, and especially as these other currencies have to start printing to deal with coronavirus and to pay their debts. It creates an inflationary cycle in other currencies. So it's kind of like a wrecking ball destroying these other currencies, right? But at the same time as the dollar gets stronger, that sort of weakens the US economy, right? Because when the dollar gets stronger, exports get weaker. And so as the US economy gets weaker, GDP goes down, debt to GDP ratios go up further. The US, and then when you look at the off-balance sheet liabilities that start coming in, which aren't even accounted for in any of the public debt numbers, right? Because it's just pension liabilities and stuff that the US has been promising people for like 60 years and now are coming due. When you combine all of that, you end up with a situation where the US economy gets weaker just as it gets more indebted than ever, and then it starts to have to print to pay its own debts. And at that point, sort of the wrecking ball shifts directions back to the US, right? Where suddenly the US has to issue more debt to pay down the debt it already has, and at some point, the people who are buying these bonds are like, listen, I'm getting zero rates or negative real rates. This doesn't compensate me for the risk I'm taking, given how much money is being printed, and they start selling bonds, which raises rates, which creates kind of that inflationary cycle, right? Because it's a huge tightening to the whole U.S. economy, makes debt burdens go up. The cycle goes in the other direction. So that's kind of how we see the wrecking ball and kind of the two tail risks that are faced by the U.S. economy. And then what I wanted to show in this chart is just like let me just get the thing up on my screen. It's just how safe haven assets perform in these types of situations, right? So safe haven assets, obviously they're called safe havens for a reason. Can anyone see the graph still? Yeah, okay, nice. They're called safe haven assets for a reason, and they always outperform in these scenarios, whether inflationary or deflationary. So you see there in the Great Depression, right, in 1930, gold spiked. That was obviously a very deflationary cycle. And then obviously you have in 1970, Nixon removed the US from the gold standard, and you had a decade of inflation where gold performed extremely well, and then after that you had the dot-com boom where gold performed very well, another deflationary crisis, and then the 2008 crisis where gold performed very well. So just trying to show how I guess gold performs pretty well in all types of inflationary and deflationary tail risk events, and it also sort of, you can see it spike slightly before the crises as sort of debt burdens start to get unmanageable and people start to fear the worst. So if you go to the next slide, I think one of the most similar times that we can compare it now to, and Ray Dalio often makes the comparison, is the 30s, right? Because we've come off a huge asset price boom. We have debt to GDP at all-time highs. We hit obviously the all-time high then was about half of what it is now, but it was still an all-time high. We have inequality at an all-time high, and we also have kind of a new world power emerge, right? We had at that time it was the US emerging to challenge Great Britain, and now it's China emerging to challenge the US, and that starts to create it starts to sort of create economic warfare before it creates physical warfare, and that has an effect as well. And if we look at how, and then obviously interest rates hit zero there as well. So, and if we see the Dow to gold ratio there, again, it's just showing, gold did 9x versus stocks. It actually performed so well at the time. Obviously, there was a different kind of dynamic because we had the gold standard, but people started turning in their dollars for gold because they lost faith in the system, and so much so that Roosevelt eventually had to ban private ownership of gold. It was a series of sort of escalating measures from banning the use of gold as in to settle contracts to finally banning private ownership of gold and actually forcing people to turn in their gold because there was a currency crisis effectively in the US. So, and then if we go to the next slide, I think the kind of the big difference between now and the 1930s and what makes this so scary is that unlike the 1930s, the rates were basically zero before this crash, right? In the 1930s, there was room to ease. We had 500 basis points to ease. Even in 2008, we had 437 basis points to ease. Here we had 150, right? Rates were already extremely low, and we also had the highest debt to GDP ever in terms of global debt to GDP. So it's quite a dangerous situation. And I think what Kev said is exactly right in that we can, there's only kind of two ways out of a big debt burden. You can grow your way out of it, which is very difficult once it gets big because you have to basically indebt yourself more to grow out of it. And eventually debt burdens get too big and you're having to issue debt to pay them. Or you can deflate or you can inflate, right? And I think the risk of inflation here is very high eventually, which is why Ray Dalio is saying that cash is trash, right? You don't want to hold cash when the US might have to print trillions of dollars every year just to pay its debt. And in the same way, bonds are trash, right? Because bonds are a promise to pay cash. They're a promise to pay currency in future. So they're tied to the inflation in that currency. And so what we see is an environment where if you think of safe haven assets right now as sort of cash, bonds, and gold, you see a situation where gold could gain significant market share versus the other two because it's not tied to the dollar, right? And then at the same time, you have, a big source of demand for bonds is sort of these risk parity strategies where you have, bonds like stock bond divides, like in your portfolio, right? Like 60% stocks, 40% bonds or whatever. And the idea there is that you get some diversification benefits from that. But as the central bank starts to kind of dictate, the central bank actions start being sort of the main determinant of asset prices, correlations start converging. So the diversification benefits that you get from bonds go down, and also the returns from bonds, they're very, very low. And so again, gold and safe haven assets start to look more and more attractive. So now moving on to sort of, and just some early warning signs of this, like Kev's already talked through this, but you have people are kind of starting to slowly ditch US debt, the central banks and stocking up on gold. We've had sort of all-time high gold purchases from central banks for the past years, and that's led by China and Russia, which are also sort of two of the US's main geopolitical rivals. And then, and this is just showing, gold's beginning to outperform. You've seen it reach all-time highs in multiple currencies, not in US dollars because of the huge shortage of dollars and the deflationary effects that Kevin described so well. And now going on to crypto. So obviously the crypto, I don't want to focus too much on the Bitcoin side because I think actually the Ethereum side is more interesting, but I think that's the first use case that we need to talk about. And like gold, Bitcoin has increasingly shown low correlation to stocks and other asset classes. And obviously the main thing about Bitcoin that's important to realize is that other than a 6,000-year-old brand, all the characteristics that make a good store of value, Bitcoin is sort of superior to gold in. And I think what we want to, the main sort of point there that's important to realize is that the characteristics, sort of the features in which Bitcoin is better become ever more important in the world that COVID accelerates us towards. So if we go to the next slide, we can see that if you move to the next, I think it's probably frozen, but so it, when you no, the one before,
Open finance, this one?
No, that one, crypto gaining market share, the nice Bitcoin gold thing.
I think I'm on a lag.
Yeah, it's all right. So you have the crypto's differentiated characteristics become way more important in a world where geopolitical tensions are rising, isolationism's on the increase, and globalization is kind of unwinding. So in 1929, from 1929 to 1945, we saw an increase in the marginal tax rate from 19% to 94%. And the marginal tax rate actually wouldn't go down below 80% for 20 years. And that's just a function of when you have a lot of debt, the government needs to sustain itself to pay that debt, right? And you know, the part of that, there was also inflation in 1946 to help pay down that Second World War debt burden, but a lot of it was increased tax revenues. And I think we've already seen crypto be used to evade capital controls in China, and I think it'll be increasingly used to evade sort of governments overstepping with extremely high taxation and capital controls in the world that we're moving into, and it will affect governments' ability to finance themselves. And the second point is sort of supply chain vulnerabilities. We've already seen with COVID, gold face like serious supply chain vulnerabilities, you know, where people haven't been able to take delivery of physical gold, and it's kind of created a big delta in the price between physical gold and sort of financial gold. And so that's something that could accelerate if we see a world of geopolitical tensions, you know, controlling sort of like the mines, the suppliers. There's a lot of ways for that to happen, and it's happened in the past during wars. Obviously, countries don't let their gold reserves leave the country, and that's something that can happen with Bitcoin. And another issue is the financial intermediation. So gold, for most people, you know, it's not very easy to own gold. You have to sort of maybe, I don't know, dig a hole in your garden and bury it or something. It's not an easy asset to own, and so as a result, most people, including me, you own a financial version of it. And the problem with that is that generally it's custodied by a financial intermediary like a bank, and often it's sub-custodied by another financial intermediary. And so what you end up having is this asset that you're buying to protect you from the worst case scenario, right? The deflationary or inflationary scenario is actually custodied by the very institutions that get hampered by a scenario like that. So that's a big problem, and again, something that Bitcoin doesn't face. And as we see awareness of that risk increase, or as we see even that risk play out, people should increasingly turn to Bitcoin. Then you have demographics and trust in institutions. Obviously, our generation, the millennials, we have all-time low trust in banks and institutions. I think there was a survey by Facebook that showed that 92% of millennials don't trust their bank. I'm certainly one of them. Every time I check my bank statement, there's weird charges that I don't understand. And so, and you saw as well that Charles Schwab study that said that Bitcoin was the 5th highest holding in millennial bank accounts, brokerage accounts, which again shows our generation's way more comfortable with the idea of digital gold and the kind of the trust curve. You know, the 6,000, it's not going to be 6,000 years basically for this thing to be trusted. Like our generation grew up digitally, we're comfortable with it, we understand it. And then of course there's utility, which is where Ethereum really comes in. If we go on to the next slide, you know, because people always say Bitcoin doesn't have utility, or crypto doesn't have utility, no one's using it. It's definitely got more utility than gold, right? And it's definitely you can build a lot more robust and flexible financial system on top of crypto than you can on top of gold. And so with open finance, again, you're going to see, firstly, I think both deflation and inflation create opportunities for open finance, right? With deflation, there's an increased demand for dollars as a safe haven asset, especially in countries where they're difficult to get. And stable coins are going to play a huge role there. We've already seen a huge increase in supply of stable coins over the last month or two. And I think that'll keep increasing and crypto will become initially sort of a technology to help export the dollar. It'll be positive for the dollar, I would say. And then you're also going to see increased demand for dollar yield. Obviously, as rates go to zero, you're going to see more people demand dollar yield, which DeFi yields are you know, orders of magnitude higher than bank yields. And then you have capital controls. You know, as capital controls and taxation increase, what we talked about before, states are going to need to pay back this debt. All this fiscal stimulus and this helping the people eventually is going to have to be paid back. And crypto is going to play a really important role in people being able to evade that and protect their wealth. And even if, for instance, synthetic assets, something like synthetics could be something that benefits from that, as people want access to financial assets without having to trust a bank counterparty, which the government can then seize your assets, right? And I think increasingly we're going to see that the sort of people having financial assets without having exposure to a financial intermediary. And then it's going to lead to it's already leading to the questioning of the dollar. You've seen Mark Carney, the governor of the Bank of England, come out and say that he thinks the dollar system is sort of doomed, and the alternative he sees is a basket of central bank digital currencies, right? And you've seen Libra come out to huge controversy. And I think, first of all those central bank digital currencies will just serve to onboard people into digital currencies. And second of all, I think Bitcoin and Ethereum will play a huge role in sort of these alternatives to the dollar and where they're built. And then finally, I think there's also an argument, sort of a macro argument, that COVID accelerates the coming of Web3, right? So you've had over the last decades, you've had these massive businesses be built, these massive monopolies, Facebook, Netflix, Amazon, and they've basically been built on network effects, right? And network effect is kind of a bug in the capitalist system, right? Because sort of what you learn in economics in your degree is that things work with negative feedback loops, right? When something diverts from equilibrium, there's a force that brings it back. But actually, this is the opposite. It's as something diverges from equilibrium, it increases and it diverges more and more from equilibrium, right? As more people are on Facebook, it's harder and harder for you not to be on it. It adds more and more value to each user. And so these things can get massive in sort of a way that the only other thing that has such as big a network effect as a social network is money itself. You know, these things can get massive and they tend to concentrate around a few. And so if you go to the next slide, I think what we've seen is we have, as sort of an industrialized society, we have experience with monopolies. You know, we had AT&T was a famous monopoly, but generally monopoly shows up in higher prices to the consumer, right? The consumer pays higher prices, and that's how you know there's a monopoly around. So with Google and Facebook, it's difficult because the products are free, so you don't actually see what the costs are of the market power you're giving up. But actually, when you look at it, there's significant costs, and I think they'll become more and more obvious with COVID. So there's censorship costs, which I don't mean like just fringe opinions, which is an issue. I mean also just innovation, right? I mean, it's undeniable that these web giants have suppressed innovation. I think Chamath makes a really interesting point that I think the R&D, the combined R&D budgets from the big tech giants for the last 10 years were about 4 times what it took to get us to the moon. You know, and what do we have to show for it, really? Not much. And it's, I think the reason for that is that historically it's really difficult for centralized incumbents to innovate. It's just because any real innovation will threaten their business, and they're not incentivized to do that. So we're missing out on huge innovation, and they hire all the startups, they hire all the good engineers, etc. And then the other big one is data opportunity costs, right? We're all basically unpaid employees for Facebook and Google, and our data is extremely valuable. You know, a study from I don't remember who, but it was estimated that the value of an American citizen is about $20 a month, and that's only going to increase, right? And so what we've seen is this has driven inequality, which is kind of expected, because when we look historically, when the labor force has least power over their employers is when inequality is highest. And right now we have no power over our employer because we're not even recognized as employees. So we're seeing a huge increase in inequality. And if you go to the next slide, it's the last one. I think what we see with crypto is the ability to kind of solve this by enabling network effects without the market power. So what you can actually have is crypto networks act as what I think Chris Berniski called minimally extractive coordinators. So you can actually let people come together. So, you know, Google is basically a giant ad network, same as Facebook, and you can let people come together peer to peer with code, consensus rules, and incentives regulating how people interact, rather than an intermediary telling them how to interact. And what this causes is kind of a reduction in the cost of networking. It makes it a lot easier for people to come together and kind of capture the value of latent resources like computing power, storage, but the biggest one is data, right? Enabling people to be rewarded for the data they own. And so there's lots of examples of these crypto networks. I won't go into it too much, but you know, you've got Bitcoin, where it's bringing a group of people together to provide security to the network. You've got Zcash, which then brings a group of people together to optimize for development of the network. You've got Kudo for compute power. You've got Steemit as a decentralized social media network. And all of these are basically creating kind of, they're redefining what work and capital is, right? Right now we have workers and capitalists. Capitalists own the shares and they get the returns to capital, and workers get paid for their labor. Actually, in these networks, what we see is that we have worker capitalists, right? You both own the token and you provide work, and the workers own the entire network. So it's kind of a digital cooperative almost. And I think this will become ever more important in the world post-COVID, where you're going to see huge concentration in the big fangs, which had massive balance sheets and managed to buy out all the startups that couldn't get funding and all of that. So, and I think that'll be a big driver. Like, sort of understanding of that will be a big driver to prompting Web3 to come into fruition. I think that's it from me. Kev, you want to add anything there?
Yeah, no, I mean, I think that was a great overview. I mean, one of the things that excites me, just kind of building off some of your points, especially on the Web3 narrative. One, I think the data opportunity, I think you hit the nail on the head. One of the interesting things, though, and if there's a project out there that's solved this or is looking to solve this, please reach out, because I would love to dig into it. But you have this really, I don't know if it's necessarily a paradox, but when you look at monetizing data, right? You mentioned, the Googles and the Facebooks of the world, and more that data also is getting access to that data is coming from companies or firms that are trying to build out AI, natural language processing, this kind of next evolution of technology. And so what I think is difficult in solving that problem is you kind of have to create, and this is why I think crypto can do this, you have to create some type of monetary incentive to get people to move to a system, because individually everyone's data isn't really worth much, right? But in aggregate, it's worth everything. And so you have to get, and that's why I think crypto can do this, if you can design the right incentive mechanism to get people to move over, compensate these early movers over to a new system in which you can actually help create the complementary system that would allow people to actually monetize their data and almost become, we think about the future of work, let's call it 10 or even 20 years from now, it's going to look drastically different than it does today. And I think a lot of the points that you hit on are the reasons why, right? If you look at the late 1930s, for example, you had worker strikes, for example, at a GM plant, and the employees were literally able to take the physical capital hostage, and that's how they were able to, push through wage increases and things of that nature. Right there was actually a physical kind of capital component. As you move into a more digital world, certainly there are certain protections, but also equal. Can reduce the individual negotiation power, so to speak, of some of these employees, right? And you have even in kind of low skill labor jobs, there's an increase in things like non-competes, the fast food industry, and so the mobility of people in a digital age is certainly going to increase. And again, some of those opportunities, I think things like privacy are extremely important, obviously, but I don't necessarily think that in and of itself would get people to move over into this new Web3 world. I think we have to really figure out ways to design not only step function improvements in some of these potential technologies or some of these services or apps that we use, but also ways in which you compensate people for their time, right? Because the monetary incentive aspect could actually be the driving force to get mass adoption of some of these decentralized applications and things of that nature. So I'm with you. I think the future world of Web3 and this kind of network effects without market power is a really interesting concept, and one that I think the secular trend is certainly moving towards. It's just a matter of kind of how we get there, and crypto allows you to kind of build in these decentralized incentive mechanisms. And we do some consulting work similar to what you guys do with certain projects, and I can just say that some of the innovation in terms of just how to think about token economic structuring, the ways in which you can play with different incentives to try and get people to do things is really, really interesting. It's honestly what fascinates me most about this space. So really exciting, certainly in the early innings, but no, I think a lot of what you said, like I said, hit the nail on the head.
So here's my question for you guys.
Yeah, thank you.
Fire away.
Awesome stuff, man. So I'm 57. My mother was born in 1909. My father was born in 1930. And so I grew up with all of the economic history that you guys just went through. Why do you think that we only see retail moving into crypto as a safe haven asset and institutional? Is institutional money blocked by bias, blocked by legislation, blocked by stupidity? Why is it that retail is in crypto and institutions not really?
Yeah, I mean, I think the space of just the mandates for a lot of institutional investors, right? When you start talking about like really big institutional pools of capital, quite frankly, the space is just too small for it to, I don't want to say for it to matter for them, but for it to be relevant right now, right? You can't have a large pension fund, for example, even if you got it through your investment committee and you have to sign off to allocate a small allocation of your portfolio into this, a small allocation from a large pension fund could be, again, billions and billions of dollars, in which this market is just too small to really absorb that without drastically moving prices, right? And so what you're starting to see, and why some of our focus is, on the Bitcoin space, but also, breaking out into crypto at large, is Bitcoin being, kind of the most liquid, as crypto asset. You're starting to see some institutions that certainly have bought into this narrative, and we've seen some of our clients who aren't even invested in this space but reach out to us just to get educated on, understand what's going on. There's certainly a lot more institutional interest than there is actual investment in this space. It's just, as of right now, it's a bit too small for institutions to actually really strongly consider it in their allocation decisions, because if they're putting in, let's say $10 million into ETH or Bitcoin or something like that, it's really not going to make much of a dent in their larger portfolios. So it's kind of this chicken and the egg, where once, the space gets big enough, allow institutional capital to come into it, or at least make some allocations into this space, starting off small and eventually getting bigger. And then that almost kind of has this vicious circle or feedback loop, where that'll obviously grow the market value of this space, allow for larger institutions to come in, so on and so forth. But we have to kind of get to that point first, before I think you really see like institutions come in, in mass.
Yeah, no, I agree. I agree with everything Kevin said, and I think one of the advantages of Bitcoin is actually that it can start with individuals, right? It can start sort of bottom up, whereas gold kind of requires institutions to intermediate it. It's very difficult for you to buy physical gold, although a lot of people do. Bitcoin can start bottom up and sort of grow its liquidity that way, so that it then can become attractive to institutions and eventually maybe nation states.
Guys, I'm gonna play the bad cop here because it's a very interesting discussion. Again, thank you so much for this very insightful deck. A lot to learn, a lot to discuss, and hopefully you guys can join the Discord so we can continue. I have a lot of questions, but now we have our crypto art opening. I hope you can stay and bring a drink to see the magic of crypto art. And if you can share the slides.
That's a great slide deck, man.
Yeah. Thanks.
Yeah.
Excellent work, gentlemen.
Yeah, thank you very much, Kevin. Thank you, Jose. Like very, very cool. And like wow, like a lot to think about. Like it's like the last talk of the day, but not the least.
Mateo thought I was sleeping, but I was sitting here and listening.
And maybe Matteo was sleeping.
No, man, he's sending me screenshots on Telegram.
All right, so let's
Well, thanks very much.